Most businesses looking to raise capital think they really only have two options. They can either take on debt or they can give away equity. And unfortunately, the reality is that most of them don't even understand what those two options actually look like or what the implications really are for their business when they take on either one of those capital raises. And it's not really just a simple decision, debt or equity. There's a whole spectrum of capital that's in between. And the structure you're going to choose to raise for your company is either going to help that company and business scale and take it to the next level, or it's going to strangle the business and its ability to grow because you didn't actually understand what you signed up for when you raised that type of capital. Now, I spent over 10 years on Wall Street as an investment banker, advising companies, and I've closed deals worth more than $20 billion all across the entire capital structure. I've negotiated and put in place almost every type of capital transaction you can imagine, whether that's early stage venture, private equity, recapitalizations, mezzanine debt, bridge financing, bank debt, private capital, strategic partnerships. Every potential capital raise transaction you could think of, I've seen it, I've been on the inside of it, and I've watched businesses give away a quarter or half of their company when they didn't need to. And I've also seen businesses that have taken on debt that crushed their balance sheet and destroyed that company's ability to operate when equity would have been a far better option and a fit for them. So in this video, I'm going to walk you through every major way to raise capital from start to finish, from the earliest stage equity all the way to the latest stage debt, who each structure is really for, and the trade-offs you wouldn't really truly understand until you've actually negotiated these instruments, raised that capital, and seen the impacts on the companies afterwards. Let's jump into this video right now. Now, before any of these structures will make sense to you, you have to understand the one thing that every single capital raise is built on. It is a fundamental equation, risk versus reward. At the broadest level, there are two buckets of capital a company can raise. You have equity and you have debt. Equity is very flexible. It's aligned with the growth of the business. It's less restrictive, and most importantly, it shares in the upside of the business. If the business does well, that equity is worth more over time. However, equity sits at the very bottom of the capital structure, which means it also carries the most risk in the entire enterprise. So the rule that's going to govern everything that follows in this video and overarching is very, very simple. The less risk the capital has, the cheaper that capital will be, which means more protections and restrictions will come attached to it, to your business. The more risk the capital has, the more freedom you will get. However, that capital will be more expensive as a result. So every option I'm about to walk you through is just a different point on that line of risk versus reward. If you understand that map and that dynamic, you're going to understand the whole framework and strategy for how to raise capital for your business. Now let's look at equity and start there, and we'll go from the simplest form of equity to the most complex. The simplest form is founder equity. A couple of business owners, founders, put capital into a business. They each own a percentage of it based on, what they contributed into the business. It's very clean, very straightforward, and typically not that many complicated issues. Very simple to do. From there, as the business grows and you start raising capital from the outside, you're going to climb into what we call venture equity. And now this capital will come in multiple rounds. You'll have a seed round, a series A, a series B, and so on from there. The mechanics are pretty similar in each round, but the type of investor and what they require will change as you climb that ladder. When investors, as opposed to individuals, put capital into a business, they generally expect a structured return on it. And equity does not work like debt, where debt has to be paid back every single month. That return on that equity can come years down the road, and these investors can be very patient. Often, this venture capital will come in as preferred equity, so it will be an instrument that sits ahead of your common equity in the capital structure, will carry a higher priority in the capital structure, and it will come with a return requirement. The investor might need to make 3, 4, 5 times their capital or hit a certain internal rate of return before anyone below them sees a dollar. So even though you hold the common equity, that preferred equity has to earn its full return first before you, as the common holder, see any value that flows down into the company. Another strategy you should also etch into your memory at this stage is the less equity you can give away earlier, the better off you're going to typically be on the back end when the company is worth significantly more. Which raises a really interesting question is, would you rather own 10% of a $1 billion company or 100% of a $50 million company? You would take the 10% every single time. And sometimes the only way to actually build up to that $1 billion valuation is to bring in the capital and take that dilution. And that's going to be an entire strategy and calculation of raising equity capital. What does this capital actually do for me? And what is the growth and valuation it unlocks? And is that worth the ownership I'm going to give away to get it? Is it accretive? Does it deliver more value and growth than the equity I'm giving away to be able to fund that capital? There's also a middle layer that sits between debt and equity, and you should understand how this functions. An institution or investor can provide you a loan, it's a debt instrument, but attach a piece of equity to it. So instruments like warrants or restricted stock units that sit inside of your equity structure and are part of the overall debt package. The lender will get paid back just like a normal lender on their debt portion. They'll get their interest, they'll get their amortization, the whole loan will be repaid over time or refinanced. And on top of that, that lender will get a slice of upside in your business through that equity instrument. It's a way for the lender to increase their overall return while taking less equity than if you had raised that as a straight equity. It's a hybrid instrument. It's a blend of debt and equity. Now, what does that equity actually cost you just beyond the ownership itself? There's obviously no interest payments that are tied to equity, so there's no cash service requirements. There's obviously no collateral once the loan is repaid, so no one will hold a lien on your business or the right to foreclose on it. Your balance sheet will stay clean from that perspective, and you won't have debt on it. The real impact is on the control side. You now have stockholders, institutions with voting rights, and have ownership rights, potentially board seats, and influence over your company who are in your business now. And that's really the true cost of bringing equity into the company. It's not necessarily the cash, but it's the control that you have to hand over. So if you're an early stage company and you're growing fast and you don't yet have the stability to carry traditional debt, but you also don't want to give up a large slice of equity, this hybrid structure, a loan plus equity, is often exactly where the most value will be for your company. You get the growth without necessarily giving up the most amount of dilution on that side. Now let's flip to the debt side, and we're going to go the other direction. We're going to go from cheapest to the most expensive. The cheapest, simplest form of debt capital is bank debt. You go to a bank, you put up your business as collateral, you're most likely going to have to personally guarantee it, and they'll lend you somewhere between 2 to 4 times your profitability. So 2 to 4 times your EBITDA. That is a leverage ratio. If your business does $1 million, for example, you might get $4 million of debt. If your business does $50 million EBITDA, you might get access to $200 million of debt. It just depends on the bank, and it depends on the quality of your business and the earnings profile. And the bank has really just one priority when they do this. They want to be the first in line if anything goes wrong in the business, so they get paid back before anyone else in the capital structure. They're going to put a first lien on the business, and in exchange for that safety and that priority, they're going to provide you the cheapest capital available to you, somewhere in the 5 to 8% range, plus or minus. It really depends on where rates are in the market at that time. You can use that capital to fund operations, to grow, to invest in the business. And for most companies, if you could support the balance sheet and the cash flow requirements of the debt, bank debt is the most flexible, most certain, and usually the lowest cost capital you'll be able to raise. The next rung up from there, when you go from bank debt, is private credit. It's the same idea as a traditional loan, but instead of a bank, it's going to come from a private institution, a hedge fund, family office, institutional investor, even private equity firms. There are hundreds of firms whose entire business model is lending debt to good companies in a private credit capacity. They're more expensive than the bank because they're less traditional. However, they are far more flexible. They can give you more leverage. They could push the debt to EBITDA ratio further. They can operate with fewer or more flexible covenants and restrictions. And these investors tend to be much more sophisticated partners than banks, whereas a bank is mostly checking that the payments have come in and the business is clearing underwriting and staying on track. A private credit lender is far more involved. They're actively managing the position and making sure that the business at a granular level is doing well and is on track. They may also want some equity tag along rights so they could actually share in the upside, though those same warrants are restricted stock units, maybe less than a traditional hybrid structure. And these deals are getting massive. You could have $1 billion transaction happen in the private credit market. It's become one of the largest sources of flexible capital there is. However, debt does come with a different burden of proof than equity. In order to raise it, you need a rock solid business, you need a rock solid plan, and your financials have to be in order. And you have to show what happens on the downside, not just the upside, because a lender is not compensated on the upside of your business. Private credit is really for companies that have moved past the early stage equity funded growth stage and aren't ready yet for the traditional bank box, and they're in the middle somewhere. So these companies are still underwritable with credit, and they're a real business and they're real cash flow, but they can't raise the normal bank debt. So that covers the companies that can support debt. But what about the businesses that can't? The businesses that are past being established, past operating well, that are struggling, and the traditional capital markets won't touch them. Well, that gets to the very top of the ladder from a debt rung perspective. So we're going to cover that next. At the very top of the debt ladder we've been talking about is what we call special situations capital. This is hedge fund and distressed debt. These are the bridge loans and rescue loans that a company needs when it's in a distressed position. And when a business needs capital to get through, let's say, a restructuring or a bankruptcy, or it simply cannot access the traditional capital markets, there are funds that exist specifically to lend into these special situations. It's a massive industry. Billions of dollars are being lent into difficult companies at difficult moments in their life cycle. It is the most expensive capital out there, and it carries a lot of equity-like features because the risk profile is much higher and the lenders have to be compensated for taking that risk on. Ideally, your company is never in a position where it needs this kind of capital, but it does exist, and knowing that it exists is part of understanding the full spectrum available to a business owner. Now, just understand that the underwriting for these transactions is highly specialized and significantly more complicated than traditional bank debt or equity or private credit. These are sophisticated, high-stakes transactions, and you need a specialist who's worked on restructuring on your side, because the last thing you want to do is negotiate and structure a transaction that ends up hurting your company on the back end. I spent my career working in restructuring and bankruptcy, so I want to make sure you're protected on that end. Now, here's a distinction that's going to change how you evaluate raising any capital for your business. An equity investor and a debt investor think about your business in completely opposite ways. If you pitch them the same way, you're going to lose traction and momentum with both of them. An equity investor lives and breathes on the upside of your business. They want the growth story. They want to understand how big the company can get, what the multiple on their capital would be, and they're looking at it, hey, can this investment become a 10, 15, 20 times return? They're taking the risk in the business, hoping that the business soars, and they want to be compensated for that risk with a share of the value that they helped create. So with an equity investor, your job is simply sell the vision, sell the opportunity, and sell the upside. A debt investor, on the other hand, lives entirely on the other spectrum. They focus on the downside. They do not get compensated if your company does well. If your company blows it out of the water and does spectacular, they get the same interest and the same principal back either way. However, if the business fails, they are the first ones underwater, losing their principal on their loan, and that asymmetry is everything. A lender does care that the business is healthy, but they're not underwriting your growth story in the same way. They're not focused on you tripling next year. They are, however, focused on you holding at least the same level of earnings and revenue so that there's stability and predictability in the business. They want to know that you're not going to fall off a cliff. They want your coverage ratios to be in check, your reserves, your downside scenarios. They basically want proof that you've been thoughtful and conservative in your financial metrics and your projections, and you're not going to be over levered when conditions in the business change and their loan needs to be repaid. So it's the same exact business, two completely different conversations and perspectives, depending on which capital pool you're actually speaking to. The way you characterize your company, you present it, pitch it, negotiate it, has to change entirely based on who you're speaking with and what kind of capital you're trying to raise and what they're solving for. If you're watching this and realizing your business needs capital and you're looking to raise it, but you didn't even know all these options even existed, and you're not sure which side of the capital spectrum you belong on, debt, equity, where you should be, which firms to approach, or how to structure the transaction, well, that's exactly what my firm does. We sit on your side of the table and help you structure a capital raise that's optimized for your business. So if you're not giving away more value than you need to on the equity side, and you're not taking on a debt transaction that's too burdensome or the wrong fit for your business. If that's useful to you, there's going to be a link down below in the description to understand what a capital raise process actually looks like. Either way, keep watching, because in the next part of this video, I'm going to show you some of the tools and tactics a lot of businesses don't take advantage of, but they absolutely should if they want to grow their company. There are a few financing tools that get skipped in almost every video like this, and business owners need to understand that, one, that they exist, and two, how do they work, because ultimately you want access to every option available that could be a good fit for your company so that you could actually optimize and grow the business. On the working capital side, you have accounts receivable financing, which is often called factoring. You do have things like lines of credit, you've got revolvers, you have equipment leases. These are all different functions and ways you could use to fund the day-to-day financing needs of the business. So equipment purchases, receivables, payables, ongoing needs of the business without necessarily building a very large structural capital raise. Very traditional tools, and they can help you grow the business in a traditional way. There's also private equity recapitalization, which lets you raise growth capital. And this one we're going to pause on for a second, because most people hear private equity and immediately assume that they have to sell their company and lose control. There are actually two very different versions. There's a minority recap, where a private equity firm buys a small piece of your business, they provide growth capital, and they build a partnership where they might take a board seat and partner with you, strengthening your balance sheet and giving you more capital as you can grow while you keep running the business. Then there's the majority recapitalization, where they take control, they buy the company, control 51%, and from that day forward, they drive the strategy, they supply the capital in the direction of the company. So you can either keep a small residual piece in there, you can take all your chips off the table, you can be fully cashed out and exit the business, and the business will keep growing. There's a lot of ways to structure it. However, the business now has access to a bigger balance sheet. Both of these are really good outcomes. They're just different outcomes with different objectives. One is going to bolster your balance sheet, keep you in control, grow the business with a capital partner. The other is more about liquidity for the owner, where you're taking chips off the table, you let the business continue to build, and have another partner come in and ultimately take over the company. So it just really depends on where you want to take your business and where you are in your personal life cycle. Now, one of the biggest misconceptions I see when businesses look to raise capital is that they think that the whole job of raising capital is finding the right investors. Everybody is fixated on it. I just got to find the right investors and get the capital into the business. However, it's not really about finding investors. It's about choosing the right structure first, the one that's actually going to fit your business and let it scale and grow, and then finding the right partner to supply that capital. A lot of businesses that I speak with, they come to me, they say, I just need someone to raise money for my company. Well, that's not really a strategy. That's an outcome that you're looking for. So before you go find anyone and talk to investors, you have to be able to answer 4 very specific questions. The first is, what am I trying to achieve? Second, what is this capital for? Third, what's the plan to deploy and invest it? And fourth, how do I eventually refinance or pay back the capital and create the value in the business that's going to justify taking this on? If you can't answer those 4 questions, you are not ready to take on institutional capital. And the partner matters almost as much as the structure, sometimes even more, because a wrong capital partner can do significant damage inside your business. Once that capital is inside your company, that investor or lender becomes one of the most important counterparties on your balance sheet and in your cap table. And contractually, they have rights over the business. So let me show you what the wrong counterparty looks like inside of a company. Picture a lender who comes into a business and they're happy, the loan closes, everything looks great initially, you put the capital to work, and for a while the business is doing really well. Then all of a sudden the market shifts, the regulations change, and suddenly the lender is getting nervous about potentially getting paid back their principal on the loan. So they start forcing you and pressuring you to liquidate the business, sell assets, sell off divisions, repay the loan right now. Whatever pressure they can apply to get themselves out of the company, even when that's the worst possible move for the value of the business. Say the loan was $100 million and they make you sell $100 million of assets to repay it. Well, in a normal market condition, those same assets would have been worth $200 million because the dip was temporary, the shift was temporary, and the business was fundamentally sound and was going to recover. Well, a capital partner who only cares about their loan will not see that and will not be cooperative because they are not compensated on the upside of your business and your business returning to normal. Timing of the market does not matter to them. The right capital partner, they obviously won't wait forever either. They're still a lender. However, they will find ways to be more constructive instead of destructive. If they're aligned, they'll hold on, they'll let the business recover, they will de-risk their position along the way instead of all at once, and they'll work with you in a way that doesn't just destroy the company. It's the same exact company in the same exact moment. If you have two different lenders, you'll have two completely different outcomes. One might be constructive and one might be destructive, decided entirely by who you let into your capital structure, not how much you let into your capital structure. So how do you actually choose who to partner with? Well, when I'm advising a business, I'm solving for three specific things for a capital partner. First of all, how much capital are you looking to raise? The size alone will point you towards who's even a potential fit, because raising $1 million of equity and raising $1 billion of equity are two completely different lists of capital providers, and you have different partners in each pool. The amount that's going to drive the initial pool, and you can actually see who's going to participate in the transaction. Second is, what is the capital going to be used for? And this one is incredibly important from a financial planning perspective. Say, for example, you're raising $100 million to build a manufacturing plant, and that plant generates $10 million a year in profit, a 10% return on the capital. If you raise expensive equity capital that needs a 20 or 25% return in order to justify it, you're now underwater on your own capital raise. That's what we call a negative carry. Your cost of capital is higher than the investment returns from investing that capital. You'd be far better off with a 6 or 7% loan where the capital you borrow earns more than it costs you to borrow it. That's a positive carry on your capital. The use of the capital should drive whether you use debt or equity, and ultimately what the structure and the form of that transaction looks like. Third question is, where is the business in its life cycle? If you're early stage, volatile, not yet stable, you're probably going to lean towards equity because you can't reliably service debt. If it's later stage, stable, consistent cash flow, you're going to lean towards debt because that is the lower cost capital path. Now, here's something businesses also need to forecast when they are raising capital so that they don't make an expensive mistake many years down the road from an opportunity and flexibility standpoint. The capital your business raises today will directly shape and impact how sellable and frictionless your exit will be, whether that's in 6 months, 12 months, or 3 years, whatever. You need to start with the high level understanding that's going to guide this structure. Enterprise value is capital structure agnostic. The value of the company is the value of the company, no matter how you financed it, whether it's debt or equity. The structure, on the other hand, will create friction on the way out if you don't set it up properly. For example, if you've got 100 different equity partners, each owning 1% of your business, selling that business means hurting a lot of cattle to get everyone on board. Now, you may have papered those investors properly so you could actually force them along in a sale. That'd be great. However, it's far easier to sell when you have 1 or 2 owners making the decisions and actually being able to execute. Now, take the debt side. If you have simple bank debt, that might travel fine in a sale. The next owner can assume it or refinance it easily. But if you have aggressive capital, bridge loans, hedge fund paper, that often carries strong change of control provisions where the moment you sell the equity in the business, that debt has to be repaid immediately, usually at a premium, because the lender wants to keep that paper outstanding and keep generating interest, and now you're taking that opportunity away from them by selling it early. And there's more that could bite you there. If you give away minority equity, for example, without papering it, the minority equity holder may have a right to block your sale, or at a certain valuation have you rebuy them, or a lender might have a first right of refusal, or carry a huge make whole where it disincentivizes you from ever selling. So none of these things formally fundamentally change the value of your company. The value is the value. It doesn't lower your company's value. It does absolutely change the equity owner's impact though, what you walk away with, because the fees and the premium premiums that are built to exit the capital structure, that takes away from your net number. So you want to make sure you don't make your exit difficult to navigate, and you're selling from a position of, I'm not doing a short-term transaction today that's going to create a longer-term problem down the road, and you're not going to be able to sell your company, even though it's valuable, because you didn't understand what you signed up for when you raised a particular tranche of equity or debt. Let me share another real-life example with you. This is a public company, so I can't share the name exactly. However, it was a services business in the industrials and energy space. When we came into the company, it was burdened under a large tranche of debt on the balance sheet that was basically strangling the business. And the business needed capital to turn it around, and it couldn't do it with the balance sheet it currently had. The existing lender was very aggressive. They were not supportive of continuing the business and continuing to be in the business. And effectively, all of the company's cash flows was being swallowed by this debt instrument. The obvious move at the initial outset, looking at it from the outside, was to find cheaper, friendlier debt and just refinance the existing lender out. And we looked at that as an option because this lender was a difficult party. They wanted out and they weren't being productive for the company. So we evaluated a whole range of debt options. We went to the private credit markets, the hedge fund markets, the bank markets, and ultimately realized that none of those options would actually help the company here, and it would just make things worse and put them further in a hole. So what we advised the company to do was to pivot to a completely different direction. And we understood that this business had real strong fundamental value. It had performed well before, and it was just in this temporary dip because of where the market was. And so we looked to raise a significant amount of equity capital in multiple tranches over time. Totaled almost $500 million over the 3 or 4 years that we worked together with this company, and we structured it very intelligently. The first thing was the tranches came in over time. So one tranche at one valuation, enough to repay the loan, get the business back on solid footing, free up cash flow. Then further along, we raised additional rounds of capital at a higher valuation so that the dilution wasn't all taken up front. The equity capital was very patient, very supportive, long-term perspectives. They backed the vision of the business and the management team. And instead of forcing a fire sale, the company actually turned around and avoided bankruptcy, kept operating, and is still running today. And so that's really the whole point of this video. In one situation, you could have a good company with a bad balance sheet, and you cannot really outrun a bad balance sheet forever. If you don't restructure the composition of the business and you don't set it up the right way, the balance sheet will eat the company alive, and you'll likely end up restructuring through bankruptcy anyways. So you need the right type of capital, the right type of partner, and having that behind you will be the difference between a growing business and a dying business. And you need to make that strategic decision way before you actually sign the check, sign the paperwork, get the capital in. Now, one perspective on the current market environment, because the environment you raise capital in will matter and have a meaningful impact on your company. Interest rates and rates in overall are higher than they were a few years ago, so the bar for raising debt is higher as well. Cost of capital has gone up, and your business has to be able to support a heavier interest load in order to justify it. And that's one of the challenges right now in the current capital markets. However, on the other side of that, there's a very big tailwind as well. There's more capital sitting on the sidelines today than at any point in history. Institutions and funds have raised billions of pounds, billions of dollars, and they are just waiting to deploy it in good companies. So if you've got a strong business and you want to raise capital, this is a capital raisers market. You have access to more supply than has ever existed, and the business that is raising the capital today holds the leverage generally. If they approach the market the right way, they position the company correctly, a strong company will be in the driver's seat when they want to raise capital today. So now you understand the full landscape of raising capital and all the strategies, frameworks, and tactics that pin it underneath. The capital that you raise today isn't just liquidity in the door, it's a decision that's going to shape your business's control, your growth, and ultimately your exit. And that exit is really the natural next step. If you're thinking about raising now and selling the company down the road, you're going to want to watch this next, where I walk you through exactly what I would do if I wanted to sell my business in 2026. It's right here. I'll see you in the video.